So to get more into this discussion, we're going to go into a little bit of what's happening with the Fed here, and a little bit of what's happening with and an argument about taxes. And so we're going to go into this was a debate. I don't know, really debate, more of a discussion. But Sam Seder is on this show. Sam Seder was host of the Majority Report. They're a big show. We've clipped them before. They're actually a really good show if you haven't seen it. And he's on this show called the Peter Bet David Show, or Patrick Bet David. I'll get it right here in a minute. But so they're having a discussion about the Fed here, and then they'll go into taxes. But we're going to look at what their discussion about the Fed, and we'll start here with Sam talking a little bit about it, because he ends up doing most of the talking in this discussion anyway. Oh, whoops.
Capacity to meet demand. It was just that it was mismatched for a long time. You're sending shipping containers to places you had never sent it before.
So he's talking about the supply problem after COVID, where things were tough to get and demand shot up.
To get them back is a lot more expensive. These things are starting to work through the system. Wages contribute a little bit because there has been some wage growth for the first time in decades, essentially.
All right. And I'm sorry, he's talking about inflation and how all this stuff affected inflation. So first off, supply demand problems, then yes, wage growth, but this is the first wage growth we've seen really in decades. So, and that affected a little bit. As we said, the San Francisco Federal Reserve said about 20% of inflation is probably attributable to wage growth.
A lot of it is also maybe the plurality of it. This is based upon the Fed numbers, is basically just the corporations seeing the opportunity to raise these rates. And so
Also
the Fed
true.
comes in, they have one tool to deal with inflation, and that is, they're a hammer. Except for I'm arguing that it's not a nail that they're hitting, it's a screw. And they're doing this, in my estimation, as a way of weakening labor. They are going to kick 1 million people.
How would you do it?
How would I do it? Well, I would deal with it fiscally, or I would just wait. I would wait, because you're starting to see the trends all move in the right direction in terms of inflation, and I would wait. And
so you wouldn't have raped.
So essentially, Sam just made the argument we've been making for the last couple of weeks, which is inflation's already going down. Why are you raising interest rates and squeezing it? Right?
Right. We keep asking, do you actually need to do anything? Why don't you just hang out and see if this keeps going the right way?
Right. So I want to show you this real quick. So there's two kind of methods when you're talking about inflation the government has to deal with this. This goes basic Keynesian economics. If you take economics in college, they'll cover this shit. But we're going to go just look at this real quick. And the first is monetary policy. In monetary policy, it's what's called demand pull inflation control, right? So the government does monetary policy or measures. So what does that mean? So monetary would be the Federal Reserve, which is basically the bank for the U.S. government. And what they're going to do is they're going to either buy more, they'll buy or they'll either buy more bonds from people or start paying back their bonds that they've issued, their treasuries. And when they do that, what ends up happening is less cash is in the system. It's now more illiquid. They're just making it illiquid again because they're buying it. If they buy the bonds back, they're putting more cash. If they're selling more bonds and not releasing cash or buying bonds, then they're sucking cash out of the system. So the amount of cash hasn't changed. The amount of liquid cash that we can spend has changed. That's one thing. Now we saw that with quantitative easing. That's one of the tools. Now, the main thing they do with inflation, though, is they can change the interest rate between the banks, because all the banks have to loan dollars from the Fed, because all the dollars sit in the Fed. The Treasury prints the money and deposits it at the bank, the Federal Reserve, right?
Right.
And so the Federal Reserve can say, well, we're going to change the interest rates of how much we loan U.S. money out for other banks, because the big banks have to go to the Fed, and then the medium-sized banks have to go to the big banks, and the big banks are going to up their rates a little bit because they need to make money, right? And then so on and so on down the line, and that ups the rates overall. Does that make sense?
Yes.
All right. So when the Fed says we're going to raise rates by 0.25%, that could translate to 2 or 3% to you and me when we're buying a car or a house or something else. Because by the time it goes through all the banks borrowing,
little channels and filters and whatever, it makes it all the way to us.
Yep.
That quarter of a percent that doesn't sound like much, in parentheses, I will say, the bigger the loan, even a quarter of a percent is a flipping lot of money if you got a big enough loan. Maybe not on a little like $2,000 thing, but
well, I'll give you this: 30-year mortgages last year, at the same time, were about 3.4%. Now they're 7%. That's because the Fed's partly mainly because the Fed's been raising these rates. I mean, there are other factors, but that's the big one, right? So that's what the Fed is doing right now. Now, when it does that and raises those interest rates, it means businesses borrow less money. So if businesses are trying to expand or hire more people or things like that, they can't do it. So businesses tend to shrink the number of people, try to shrink their wage costs to maximize their profits, which ends up meaning they lay off people and squeeze the job market and try to lower the wages. And that's what's going on. So that's what's happening right now is the Fed is trying to squeeze the job market and lower the wage amounts, thinking that's going to offset inflation. But once again, our argument was that's not the big cause of inflation. And it probably won't do much, if anything. And it might not do anything. But that's what Sam's basically arguing. It's basically that argument. And that was the argument we did. The professor from Wharton made the same argument.
Right. A number of weeks ago, we essentially did the very same thing.
Yeah. So Sam's just making the same argument. So let's see what they do from here.
I would have probably done maybe half of what they've done. Maybe.
So 2.5, whatever the number is.
Yeah.
You mean the most recent?
No.
Right?
He's
No,
saying
today,
whatever's
I
happened.
mean, look at it today, right? Like they're worried about the banks. At the same time, they're like desperate to we need to kick 1 million, 2 million, 3 million people out of work. They're explicitly saying this.
So I'm gonna go with this. So Sam is he's right and he's sort of wrong, not entirely wrong. To say we're worried about the banks are pissed about them raising the rates because it cuts what they can do. It costs them money. And you got to remember, banks are required to have certain types of investments. Not all of the banks, but most of them are, right? So we're buying the investments as the bank that are treasuries, they're low interest, blah, 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 blah. They're secure. Now we have these things. Now you're raising the interest rates. Well, our stuff is getting, say, 2%. Well, now you've raised the interest rates, so now all the new issues coming out are getting 3 or 4. So now the value of all of our stuff has gone down. Because why would you buy ours at 2% for the same price as one you can get with 3 or 4% interest? Right? It does when you can make more money. So now we have to sell our stuff at a discount if we go into problems, or we have to raise money. So you just shrunk our bottom line heavily. You just upped our red and narrowed our black because it's not worth as much. The shit in our vault is not worth as much as it was before. So the banks are pissed too, right? So this isn't really helping the banks. So this is part of what's causing the banking problem. The banks don't have as much liquid shit. And anything they sell, they're going to have to sell at a loss. So you kind of missed the point there. But, but he makes the good point but the real thing is, if this goes into, you squeeze the job market and we go into recession, it's going to be about 2 million people that are going to lose jobs and stuff. But, it's going to hurt everybody for the most part, especially working class people. So it's kind of a whole stupid thing. I can't remember if Patrick Bet-Davis... what's his name? Let me make sure I get it. Patrick Bet-David. Sorry, I can't remember if he has a response to this. We'll see if he does, real quick.
And so That does not make sense to me.
Sam, a guy here, Scott Rodriguez, just said, sorry, but 80% of the loans given the last 3 years only required 5% down payment. It was much harder to get a loan in the 90s.
In terms of mortgages?
Yeah, that's irrelevant. The down payment amount is kind of irrelevant to the discussion. We're talking about the interest. So I don't know where he's going from there, but